I've kind of come to the realization that in order to really get design the seat at the table that it deserves, I think it's useful to be there right at the point where the table's being assembled. And hopefully you're one of the people there with the IKEA instructions and you're actually able to decipher how to assemble the table, and you're seen as incredibly valuable right from the start. And so my reason for getting into venture was basically to try and embed more of a design culture as early as possible into the companies, at the starting space, so that when the head of design, the director of design, the VP comes in, they're not coming in and trying to convince people to do something they've never done before. They're actually being brought on board because the founding team really values design and wants to get the best design possible.
Hi there, I'm Tom Pryor, curator of Designers in Business and host of the Designers in Business podcast. My guest today is Andy Budd. Andy's a fellow Brighton resident who I've been aware of since very early in my own design career. Firstly through the UX agency Clearleft, a company he co-founded back in 2005. That same year he started Deconstruct, the UK's first digital design conference. Talking of conferences, Andy's been a speaker at close to 100 events around the world. His most recent talk, Design's Midlife Crisis, is all about the intersection between business and design. I highly recommend catching it if you haven't already. I'll make sure there's a link in the show notes. Andy's also heavily involved in the world of design leadership. He started a Slack community of directors, heads and VPs of design, as well as setting up the popular leading design events in London, New York and San Francisco. A few years ago he turned Clearleft into an employee-owned agency before making his next move into the world of venture capital and startups. In this interview we discuss what venture capital is, how it compares to other funding models, and what the process of securing VC investment looks like. We also cover how taking equity in an early stage company works, and the potential upsides for those willing to jump into startups as founding designers. It's worth mentioning that we touch on the topics of investing and risk, and neither Andy or I are qualified financial advisors, so nothing we cover should be taken as advice on that front. With that little disclaimer out of the way, I really hope you enjoy this episode. Andy, welcome to Designers in Business. It's a pleasure to have you here.
My pleasure. I'm a huge fan of the newsletter. So, kind of classic, long time follower, first time live guest. But yeah, I'm really excited to chat to you about design and business and the startup ecosystem and everything that's sort of contained therein.
Brilliant. Looking forward to getting stuck into the conversation. So thinking about where we get started, maybe we should start by understanding how someone from a design and design leadership background, such as yourself, gets into the VC space. So yeah, maybe set the scene a bit about your background before we then sort of dive into the mechanics of startups and funding and how all that stuff works.
Basically, my background is I come from an agency background. I spent my life trying to sell the value of design to clients. Often they'll believe in the value of design enough to kind of sign off a big project. But then when you're actually delivering the work, there's often a lot of kind of debate and discussion and pushback. So that's an experience I had from the agency point of view. One of the things I'm doing now, as well as the VC stuff, is acting as a coach to design leaders, so heads, directors and VPs of product design. And one of the big challenges they have is kind of similar to the challenge I had at Clearleft, which is trying to raise the profile of design. A lot of these leaders come into large organizations. They really believe that design can have a massive opportunity to unlock value, both user value and business value, but they struggle to make the case. And I come to the realization that one of the reasons I think they've struggled to make the case is because the culture's already been set. Maybe design was brought in a little bit later on. The original team were probably engineers, founders, business people. They get an MVP out, they raise some money, they get some customers, they get some more money, and then maybe they bring in designers. So designers are often a little bit late to the game. And as a result, they're already starting on a bit of a back foot. So with this comes a belief that, well, if you want to get designers in the founding team, well, one way is to be a founding designer, to join an early stage startup, to be number 3, number 4 hire, part of the founding team, and you bake designing from the start. Even better, I think, is to get more designers starting their own businesses. Because it's all very well us kind of moaning about, our business, partners, executive team don't believe in design. Well, the way around that is to own the table, to build the table, to be responsible for the table. Like if you get to design the table, then you get to decide who sits around it and you're going to take the primary seat. So the reason for getting into the venture space is to try and encourage more companies to consider design and encourage more designers to consider the business side of design starting their businesses. So if you're a designer and you're wanting to start a business, then this is where things like venture capital starts to crop up. Now, the problem most people have, particularly designers have, if they want to start a business, is if the business is going to be any good, you probably need to leave your current job and you need to dedicate time to it. You might be able to kind of bootstrap it in the early stages. You might be able to, do consulting 3 days a week and then work the other 2. Or if you're young and maybe you don't have any dependents, you might be able to do evenings and weekends on your passion project while earning a wage. But unless you happen to be independently wealthy, unless you happen to have a partner that's willing to support you through their funding, you might need to go out and get enough money in order to spend that initial 6 months or a year building your business. And you might also need additional money for hiring a designer, hiring an engineer, hiring a sales team. You probably need a bit of money for server costs for your Amazon cloud services. You might need marketing, all this kind of stuff. So unless you're in a position to bootstrap, and bootstrapping generally means using your own resources to really, really quickly deliver revenue and then grow based on the revenue. But that's tough. Some businesses, if you're selling jewelry, you can go to a market, you sell 5 items of jewelry, it allows you to buy 10 more. You sell those 10, it allows you to buy 20 more. Bootstrapping is often an easier thing to do in a physical environment where you can start delivering value really quickly. Quite often, it might take you a year to get the product to a point where you can launch it. And it might take you another year to convince enough people to start paying for the product that you can cover all the costs. In the startup world, people call that being default alive. The idea is being like, when you start a business and you're VC funded, you're kind of default dead because you're not actually making any money. And it's only at the point that you reach break even that you're kind of default alive. That if you didn't raise any more money in the future, you'd still have enough money coming in to pay all the bills. So the key to fundraising or finance is, assuming you don't have a big trust fund or you've got friends that can give you a ton of money, or your parents or what have you, or you can work for free for a year, is how do you get the money that will last you the year or 2 years you need, or more, 3 or 4, until you can get your business to the point that it's breaking even and paying everyone's wages. In the olden days, you might put together a business plan and go to your local friendly bank or building society. And you'd pitch your idea and you'd have this 20-page business plan with cash flow forecasts and that. And your friendly banker would go, that's a brilliant idea, here's the money. The challenge is that most bankers are incredibly risk averse. So they're looking, first of all, for a really low risk business that has got a 95% chance of success. And also, if you fail, the banks don't want to lose. So the banks might give you a loan, but they say, hey, look, we really believe in you. Here's a loan, but you've got to pay it back over these 3 years. And if you don't pay it back, we'll take your house. That isn't much fun. That's hugely risky. The risk is all on your side. None of the risk is on the funder's side. And worst case scenario, you'll lose your house. And so many, many people are worried about going into entrepreneurship and getting a loan because the risks are too high. In comes this class of investment called venture capital. And venture capital is very much about investing in very high risk businesses. The model of venture capital is assuming hey, if we invest in 50 businesses over a 3-year period, we reckon that 45 of them won't actually survive. But the 5 or 10 that do, they'll not only survive, but they'll thrive. And they'll pay for the losses that we made in the other 40. And actually, hopefully, they'll return 3 times the value of the fund, which is kind of generally what your VCs are looking for. Your VCs will go and raise money. They'll create a fund. Let's say the VCs have gone out and raised 50 million to invest in startups. The people that they raise money from will want 150 back, maybe 200. And so your job is to invest in enough companies so that the really, really good ones, successful ones, thrive, and they thrive returning you 20, 30, 40 times your initial stake. And that pays off all your debts, it pays all of the other investments, and leaves some money over for the people that you've raised your money from. And what you typically find is when it comes to startup investing, there are different points at which you get invested in, and there's different points at different names, and the different names generally come with different levels of investment. So the very first round of money you might get is often called pre-seed. Sometimes it used to be called maybe a friends and family round or an angel round. The friends and family round, as the name suggests, is money coming from people you know. I don't know about you, Tom, but I didn't grow up with a family that had any spare cash. So I think the friends and family round language has disappeared and people don't talk about that now. But sometimes you might do a little angel round, just to kickstart the amount of money. You might take 50, 100K, and that might give you enough time to run for 6 months to get the idea off the ground. You then have pre-seed, and that's usually where the first institutional investors come in. And by institutional investors, I mean professional investors. Not friends, not family, not angels, but some kind of fund. And they'll look at, dozens and dozens of startups, hundreds, thousands of startups maybe, and they'll decide to invest in half a dozen, 20 a year, whatever their investing kind of cadence is. And they might say for a pre-seed round, we might give you 250K, 500K, something in those kind of levels. But rather than this being a loan, the VCs aren't expecting you to pay this money back over the course of 3 or 5 or 10 years. And they're not going to let you put your house up and risk your house. What they say is we're going to take the risk. We're going to give you this money, but in return, you're basically selling us a part of your business. And you typically find that for each round of fundraising you do, you might be expected to sell effectively something between 10 and 20% of your business. So as a VC, I give you £500,000, I get 10 or 20% of your business, and then you go about delivering the thing. And then maybe in a year or 18 months' time, you start running out of money. So you do your next fundraise, which would be called seed. So seed is the one after pre-seed. And then maybe 18 months later, you do a Series A, and then a Series B, and a Series C. And there's no kind of real limit to the number of series you do, but the goal ultimately is that at some stage, the founder, but also the VCs, the investors, will get their money back. If they're not getting their money back by getting you to pay them back interest rates every month, how do they do that? Well, basically, there's 2 ways that VCs can make their money. You either sell your company on the private market to another company. Let's say Google comes along and says, hey, Tom, I love your idea here. We're going to buy your business for $1 billion. So they buy the business, they give you the money. The VC fund gets 20% of that, and then they distribute that to their LPs, their limited partners, the people that funded them. The other way is you go, okay, well, we don't have a private buyer, but we will launch on the stock market. People regularly call this an IPO, an initial public offering. So you'll launch on the stock market and you'll sell shares, and people like you will go, oh, I'll buy those shares. I like what Google are doing, Facebook are doing, Airbnb are doing. I buy those shares, and then that money comes to the owners of the business, which will be a collection of VCs. And so typically at each stage of this fundraising journey, there's a level of expectation about what you will need to get to in order to unlock the next level of funding. And it changes between VC firms and startups, but the goal is to kind of keep proving the model, keep proving that this business can grow to the point where it has an exit, and that exit will then deliver the returns that everyone's agreed. The downside of this is that VC funds therefore encourage 2 things. First of all, they require those startups to be very successful, to pay for all of the companies that aren't successful. So there's a pressure for them to be big. This is why you see these kind of discussions around high valuations, unicorn startups, companies that are worth $1 billion or more. The VC companies, in order to make their returns and not lose money, they need the 1 or 2 or 3 of their portfolio companies to get those large level returns. And so there's a pressure to kind of grow really quickly. And then also there's a pressure to sell. So if you told me hey, I want to build a lovely sustainable business that does £5 million in revenue a year, makes me £1 million, £2 of profit, that's a wonderful business for you. And you want to do it forever. I never want to sell this business. I want to just make profit and have a lovely life. That's a brilliant business for a founder. But it's a terrible business for a VC because they're never going to make much money off of it. And if you're never planning to sell, they're never going to get the return realized. And so people talk about VC scale businesses. There are certain kind of businesses that are VC scale that would attract that level of investment. The downside is there's a massive gap between a VC scale business and a thing that the banks would invest in. So I think a lot of the challenges that a lot of people have when they're starting a business is that like they are forced into this VC scale business because they can't get the funding from a bank, but they might not want to be this big, massive business. And so in some ways, in order to kind of get the funding, it forces you down a route that might not always be the right route for you. But sadly, there's very few other opportunities for funding out there. So there's a kind of interesting, kind of challenging space at the moment.
Interesting. I'm really glad we've touched on this point in particular. Actually, there was something I was going to ask you about later in our conversation, because there is this impression that in the VC space, there's this kind of growth at all costs mindset that can feel a little off-putting, particularly maybe to people in design who don't feel like they can align with that ethos. But it does sound like there's this massive gap in scale when it comes to funding options between sort of bootstrapping at one end and big VC-backed businesses at the other. Are you seeing anything emerge in that middle space that maybe feels like a good compromise between these two approaches?
To some extent, I recognise the sort of feeling or the vibe that you express, that designers often feel uncomfortable about kind of growth and that sort of scaling side of things. But ironically, I'd also say there's nothing necessarily ethical about artificially holding back a product that could improve many, many more people's lives, but you choose not to do it. I'd say small can be something that's a labour of love, that can be high quality, and actually you're not trying to get it into the hands of as many people as possible. In fact, you could argue that like high quality design is quite the opposite of good and ethical, because often it's out of reach, often it's exclusive, often it's really expensive. Like I want to build the world's best, most delightful email system, and I'm going to charge a lot of money for it, and I'm going to limit access because I want to have an ethical small business. Well, actually, is that good design? Surely it's better design to put this amazing, positive, much better design system into the hands of as many people as possible. And actually, maybe it's your own ego or your own fear that is preventing you from doing something that has a much bigger impact. And that's not always true, but I think it is worth kind of saying that like a lot of people equate small with good and ethical, and that's not necessarily true. There are lots of lovely small businesses that struggle to stay lovely small businesses because they can't get the funding. There are increasing ways to get money based on your income. So, I mean, a classic thing that some people do, less startup-y but more agencies and traditional businesses, called invoice factoring, where basically a bank or a company will look at how much you've invoiced and go, okay, well, look, you've invoiced £500,000. You're probably not going to get paid for 2 or 3 months, but we know you've got that money in the bank. We'll give you a loan for that amount. And so what that can do is that can help you realise the money that you've got outstanding but isn't in the bank. You can get it sooner. And maybe if you get it 2 or 3 months sooner, that will allow you to hire that designer sooner, or that engineer sooner, or pay for that Google ads sooner. And if that Google ads then drives more revenue, then the thing becomes cyclic. An extension of that is we're now seeing a number of platforms that will actually use AI to look at your growth of your product and go, oh, like we see that you've got 10 million in annual recurring revenue. You haven't even invoiced it yet because you're invoicing monthly, but we, looking at your, doing a deep analytics of your finances, we really believe that you're gonna earn this £10 million. So we will give you a loan, and we might give you a loan of £5 million, and we'll give you a loan at 5% interest rates. And so what you're doing is you're kind of effectively, rather than getting the money that you have already earned but haven't been paid for 2 months, maybe you're saying, we'll get next year's worth of money and we'll invest it now. And then the year after, you'll get the year after that money and invest it now. And so that can be a way of getting more liquidity. Liquidity is basically a fancy finance term for cash in the bank. But it only is dependent on you having the customers already. You just haven't invoiced them yet. So that is still bootstrapping. It's a way of bootstrapping a little bit quicker. That is kind of a common way for SaaS companies, software as a service companies, that they're growing and their numbers are growing, but they haven't quite got round to invoicing everybody yet because they're on a monthly basis. So I think there are ways of doing it. But realistically, if you're very high risk and you've got, like a 1 in 50 chance of making it, you have to, have a 50 times exit for it to be worthwhile. So I guess that the challenge is like, who are the people that are investing in high risk companies that don't mind that risk? Well, there's not that many people because they want to make a return. The only way to do that really is to have a much, much lower risk business. And if you've got a much lower risk business, then you might find some local business angels. You might find they want to put sort of 20, 30 grand into your company, but rather than expecting an exit, they might ask you for, a cut of your revenue. That's often not a very, very good deal for these businesses. You end up selling much, much more for much, much less. I struggle to see in the current setup a way that can successfully finance high risk businesses that doesn't involve the multiples that are required across the board.
Okay, so let's say, given this is the sort of mainstream funding landscape we are working with at the moment, let's say I'm a designer with maybe a higher risk business idea, and I do feel like venture capital is something worth exploring. How do you recommend a designer sort of starts that process of looking into options in the VC space? How do they reach out to VCs? What does that process look like? And what some of those first steps you'd recommend people take?
I think the first thing is to understand what investors are looking for. I think there's a fixation or a belief that investors are looking for like a brilliant idea. And obviously like a brilliant idea is helpful. But, Google wasn't the first search engine. Airbnb wasn't the first place that let strangers crash on your sofa. Uber wasn't necessarily the first service that allowed you to rent a taxi via a smartphone app. So just because you've got a genius idea, it doesn't necessarily mean that you'll be able to deliver it. So really what people are looking for are a team that they can believe will be able to deliver a business and deliver it at this scale. And so, ideally if you're a founder, you want to start by building a really, really credible team. So having an engineer that's built products of scale before, having a co-founder who has maybe had some experience running a business, or maybe has worked in a startup and seen that kind of process grow. You want to be certain as an investor that this team can hire. So it's useful to, have some people in your team that have worked in engineering or design before, or sales or whatever it is, and how to hire those people. Just saying, I'll stick a job ad out and people will come isn't enough. You want to get the best people possible. You want some track record that they've actually delivered stuff in the past. Hey, I've got a crazy idea. I want to do Spotify for cats. Well, that's great. Can you demonstrate that you in the past have built something that, you've got to market, maybe in your past company or some other way to prove that you've got the ability to deliver that? And if you haven't, the idea doesn't matter. If you can't deliver the thing and if you're not a credible team. So I think building a team, finding co-founders is a big part of the journey. And it's one that often people start too late. I mean, a lot of people, single co-founder, have a good idea, but when they're put in front of VCs, the VCs will ask them a bunch of probing questions around their ability to deliver, how they're going to go to market, how they're going to sell, how they're going to know what good looks like when they hire designers, engineers, and they don't have credible answers for that. The other thing you probably want to have is a demonstrate why you're the right person to solve this problem. If you're doing Spotify for cats, are you an avid cat lover? Have you produced a best-selling CD of cat sleep music? Or are you just some crazy cat person that just thinks it's a brilliant idea? If you can demonstrate that you are embedded in this community and you understand, hey, actually, my family run the biggest sort of cat high street retailer, so I know how to get cat related products and merchandise. What your kind of USP is, what your unfair advantage is. And so making sure that you can answer some of these questions as to why, not only why this idea, but why now and why you. Once you've done that, you want to put a bit of a deck together. And your deck is kind of the calling card that kind of explains what your business is, what you're about, why you, all of these kind of things that answer these questions. And then what you need to do is you need to get your deck in the hands of VCs. The big mistake I find a lot of designers do is they look at their LinkedIn and go, oh, I know 2 people that are VCs. I go and talk to them. And they'll start fundraising. And they'll have one conversation and the person didn't like it. They'll have another conversation, the person didn't like it, and then they'll give up. It's like, I spoke to 2 VCs, neither of them liked it. Like where I'm based at Seacamp, like we'll get like 500, probably more. We'll probably get sort of 5,000 rather. People send us their decks a year. We might look at 500, we might invest in 50. So the reality is it's a numbers game. You need to invest, you need to find a whole bunch of investors. You need to pitch to a large number of them with the expectation that 95% of them won't be interested, but 5% of them will. That investor that actually their parents run a cat sanctuary, that investor that's got 5 cats at home and really, really wants to have a lovely music player for their cat while they're out to keep the cats calm and entertained. You'll find that person that believes in your vision, and they'll go, yeah, I'm all into this. Like, here's a check I'm going to write now. And so what you need to do is you need to do your sales pipeline. You need to read up on all the VC firms. There's about 200 VC funds in London. There are many more around the UK, and there are many, many more in Europe. Do your homework. Look at their websites. Look at what they've invested in. Are these the kind of company that will invest in an engineering problem? Have they done a lot of investment in heavy tech? They're probably not going to be interested in your cat idea. But maybe they've invested a lot in music and they've got connections in the music industry. Maybe they were the first investors in pets.com. So you find a bunch of investors that you think are going to align with what you're doing. And then you kind of create a little bit of a list, like who am I going to speak to first? Who am I going to speak to second? You probably want to have a list of about 50 people you're going to connect with. And then you need to kind of figure out how am I going to connect with them. Ideally, you want to have an in. You want to be connected with them on LinkedIn, or one of your friends has worked with them, and you go, okay, look, John, look, Reefer, I know that you're connected to this person here. Can you make me a little introduction? Maybe if you don't do that, if you don't know them directly, but you're friends with somebody that they invested in, that's also great. Like if a successful startup that a VC's invested in says, oh, you should speak to my mate. Adil's got a really, really great product. You should look at it. So warm intros from people you trust are always better. But again, most of us don't have friends that are VCs. So then what you've got to do is you've got to do a bit of research and go, okay, well, who do I connect with? Maybe you look up on LinkedIn and you connect people via DM. Maybe you realize, oh, look, that person's very vocal on Twitter. Maybe I'll reach out to them on Twitter. Maybe you just, worst case scenario, all of the VC firms will have an email on their website and you'll connect to their email. The downside of that is if everyone else is contacting them via their public email, they're probably going to be inundated, and so you might not stand out. Whereas if you email someone directly and say, oh, hey, hey, Andy, really big fan of what Seacamp are doing. I really love the music company that you invested in the other month. I've got a music company that you might be interested in. Let's chat. And then basically what happens is you'll line up a bunch of pitches. You have a chat. They like you. They say, hey, come in and speak to my buddies, my team. And then you'll have some kind of partner pitch. If you want to talk to those 50 VCs, let's say 25 of them are interested. You want to line up 3 or 4 pitches a day for a 2-3 week period. And you want to pitch. Every pitch you do gets better. Every pitch you do, they'll ask you a bunch of questions which you've never heard before, which will improve your pitching. And so probably halfway through, you'll actually be doing the best pitches possible, because you'll have all the information and you'll be really, really, you'll know all the questions, you'll know all the curveballs, you'll have answers to everything, and you'll be really flying. Which is also why, to some extent, you might not want to pitch your favorite VCs right at the start. Like you might want to do a couple of demo runs. You might want to go and, pitch some good VCs, but not like your perfect ones, because you're probably going to be a bit rubbish. They're probably not going to, to sign up. Another problem that I see a lot of people do is they just stretch their fundraising out. They'll have a meeting one week and then nothing, then the next week and then nothing. And investing is very much about FOMO, fear of missing out. If I speak to you and you say, oh, I'm doing a raise, and I say, oh, who else are you talking to? It's like, well, nobody else. Well, what's the risk of me not investing now but waiting? Like if I don't invest now and I leave it to see what happens, you're not going to give that investment away to somebody else. You're not going to give your shares away to somebody else. So I'll probably hold off. If you tell me, actually, look, I'm talking to this amazing VC tomorrow, this amazing VC on Wednesday, these two amazing VCs on Thursday, I'm going to go, crap. Like, I quite like these people. By the end of the week, they'll have spoken to all of my competitors and they might, be quicker to get this deal. I better get in there and I better kind of offer them a really good offer now. So that kind of fear of missing out is really important. So you need to make a reason why your investors that you're talking to want to invest now rather than wait for a month or two. Because the reality is it's in their interest to wait. If I can wait and not invest money now, but invest money 2 months down the line, that's 2 months more time of you having built stuff. It's 2 more months time of you having onboarded users. It's 2 more months worth of evidence about whether the users are willing to pay for anything or not. And so I get more information the later I can invest. And so your job as a founder is to kind of take that away and go, no, actually, like if you leave it, you're out. Like we'll come back to you in 18 months time, but in 18 months time, you won't have, you'd have missed out on all this great opportunity. So have a really, really good kind of cadence and velocity. If you're raising over a 3, 4, 5, 6 month period, you're not focusing on your product. You're focusing on raising money. Like if you're spending 6 months raising money and 6 months building your product, well, that's really bad economics for a start. Like, as I'm going to invest in you and you're only spending 6 months of the year building your product, I want to invest in teams that are spending 10, 11 months of the year building their product and only a month or two raising. So as a founder, you want to get through that raise as quickly as possible because your goal isn't raising money. Your goal is building a kick-ass product that customers love. And so the quicker you can get through that and get back to the important stuff of building your business is the better.
Brilliant. I think it's super, super helpful to hear that process broken down like that. And it's a process we've spoken about in the past that you don't see as many designers going through as, say, engineers or those from a sales background. Going back to your analogy earlier, which I really loved about wanting to encourage more designers to build the table rather than work to get a seat at it once it's already assembled. How do we encourage that a bit more? Because, we don't see that many high-profile, mainstream, particularly tech businesses that have been started by designers. Certainly not that many unicorns, Airbnb aside. So it feels like there might be something holding us back as a discipline. Do you have any thoughts on what that might be and any advice for designers looking to break through that, maybe build a bit more confidence to push forward with a great business idea?
I think one of the big problems is also one of the things which is great about design, which is that design is intrinsically satisfying in its own right. So someone gives us a problem. Oh, that's fun. We're going to fix it. And then someone gives us another problem. Oh, that's fun. We're going to fix it. We can have a career of other people giving us problems and us fixing those problems, and we really, really enjoy the process. So I think there's a real tendency for designers to work in areas where they just get access to a high volume of problems. That's often being a freelancer. I know plenty of people who are incredibly talented designers that could, that could be really, really brilliant business people, but get stuck in this sort of hamster wheel of being a freelancer, shipping small little products that are fun to do, but are delivering value to other people. It's also safe. It's in our comfort zone. Like, actually building a business sounds fascinating. Like, a lot of designers talk a good talk about kind of understanding the value of business. But when push comes to shove, it's much safer to stay in our lane and kind of, do design work. Actually, when designers are asked to kind of, okay, you really believe that design can advance business? Do you want to step up and take the risk? Oh, no, actually, that feels a bit awkward. No, I'm just going to stay here and moan about how my founders don't understand design. So I think there's a safety and there's a comfort there. I think also we're very tribal. When we go and work in businesses, we like to go and work in businesses that already get design and already have a big design team, which means if we're going to go and work somewhere, we're as likely to go and work in a big established business as we are a startup. In fact, startups feel a bit scary. They're a bit fast moving. So there's safety in working in a big, slow moving beast. But also you're surrounded by other amazing designers. So it's like, hey, I'm a designer. The best way for me to learn is to work with the best designers in the world. And so I want to learn in a big team with loads of other designers. The problem is, and that's great, you will advance your career by surrounding yourself by other amazing designers, but it also means you're going to be the 10th, 20th, 30th designer in the room, which means you're going to be the 100th, 200th person in the room, which means you're going to have very little influence. There are 199 other people before you that are more influential. Why should they listen to you? If it is a startup, 200 person joining, you will have very little equity, you'll have very little ownership. So if the business does well, you're probably not going to make that much money. If you're not going to make that much money, you're probably not going to go off and invest in startups or start your own startup. You'll get another job and you do it again and you do another job. Whereas I see a lot of engineers who are like, I'm going to be the first engineer through the door and I'm going to own 20% of this business. The desire not to be the first person through the door, the desire to be with a tribe of people, means that it's very rare that the designers get exposed to the early stages of the business or have any kind of meaningful ownership. So realistically, the other problem is, like, if you don't know anyone that's done this, you're not going to be encouraged to do it. If you're a designer and you barely know anyone who's a VP of design, let alone a CDO, like, you're going to artificially limit your horizons. So I think the designers that do this and do this well are often actually, ironically, less experienced designers. You're 2 or 3 years into your career, you might have done your first stint at Deliveroo, a really exciting startup asks you to come and join as their first designer, team of 5, you're the 5th hire. You're getting 2% of the business. In a year's time, you're asked to hire your second designer, then your third, then your fourth. In 3 years' time, you're now the head of design. And you're now having to manage 20 people and hire 2 or 3 directors. Now you're a VP of design. You're running a team of 30, 40 people. And you've done that over the course of 5 or 6 years. I see a lot of designers now who are in their late 20s who have gone really, really rapidly through being a designer to a lead, to a head, to a director, to a VP, because the speed at which the company they're in has forced them to grow at the speed the company is growing. And that is quite uncomfortable for a lot of people. But if you're in the right stage in your career, that can be a real accelerator. By comparison, most designers in large companies have to wait until their boss leaves or dies. And then you step into their shoes. Then 5 years later, somebody else leaves or dies and you step into their shoes. And it takes you 15 or 20 years to navigate through before you get to the hallowed ground of being the VP of design. And by the end of that, you're exhausted, you're tired, you run down, 20, 30 years to get to a VP. You don't have any energy left in you to get the next job or the job after. And then you do what I did and you quit and you become a coach, which is what every aging VP of design does. They start a coaching business.
I look forward to that phase of my journey.
So yeah, I think those are some of the reasons why we're not seeing that. People aren't seeing it as part of their culture. They're not seeing their friends go down that route. It's not aspirational, which is another reason why I wanted to get into VC. There is a growing group of about 20 or so designers turned VCs in the US, at least heading from the US. Google Ventures, Jake Knapp, Daniel Burker, all these people that brought amazing design into the Google Ventures ecosystem. You've got the designer fund in the US, and you've got increasingly a lot of designers that have worked in big tech companies that have made a bit of money that are now being angel investors and VCs. Not so much in the UK. So I'm probably not the first UK based design VC, but I'm probably one of 3 or 4 maybe. So I'm wanting to make this route and make the idea of starting a startup, investing in startups, more viable. Because the more people you see doing this, the more people you see talking about it, the more people go, oh, that's interesting. It used to be the case that the only route for an entrepreneurial designer was to start an agency. And then you bimble along for 5 or 6 years and you have 2 people working for you and 3 people working for you. And then, the pound tanks against the dollar and, then you have to let one person go. And it's a really, really difficult experience, like running an agency. But weirdly, all of the energy, all of the enthusiasm, all of the skills you need are exactly the same skills as you need to run a startup. I guess this is kind of what I saw a little bit with Clear Left. I spent 10 or 15 years building a moderately successful agency, which was brilliant. I mean, we had an impact on the world, but we were still a 30-person kind of small ish agency in Brighton. I just want to sort of encourage designers to go, okay, my only route now isn't to start another agency and replicate what Clearleft did, because it's a really tough time to start agencies, but it's a really good time to start startups. It might not work, but you'll get paid, you'll get money, you'll have a business experience. This is the other thing. Like, a lot of people were talking about, like, hey, like, maybe I should do an MBA. The best MBA is spending 3 years starting a business. Like, you'll learn so much more from building a startup over 3 years than you're learning any MBA. So if you're a designer thinking about doing an MBA, save your £50,000 and go and start a business. You'll get paid to do it.
Interesting. So let's say maybe I'm a designer who's not quite ready to start my own business. Maybe I haven't got that killer idea. I'm not ready to go on that funding journey myself, but I am interested in this concept of being super early with a startup who has secured meaningful investment and has like a healthy runway ahead of them. And I'm going to take that leap and I'm going to be the first designer through the door because I've spotted a promising idea with an exciting team behind it. What does that look like practically when it comes to taking equity in a new business and having some of that skin in the game as the founding designer?
In the US, it's really common for engineers and increasingly designers to trade away some of their salary in return for equity. In fact, that's the whole point. The whole point is you're a startup, you don't have a lot of money, but you do have this thing called equity, shares in the business, which you can give away. And at the moment, you can give them away because they're not worth an awful lot. But there's a possibility that in a year, 5, 10 years, they might be worth a hell of a lot. If I give up 20k in salary now, that feels like a lot, but there's a chance that that could actually turn into £500,000 in 5 years' time. And risking 20k for a 1 in 10 chance of earning 500k is a pretty good deal. Of course, you've got to be financially stable enough to be able to not take that 20k. And also you've got to be convinced enough that you're going to be able to turn that 20k into 500k. But a lot of people do it. I think previously, like 3 or 4 years ago, a lot of designers in the UK, a lot of people in the UK thought that sort of equity was sort of just imaginary play money. So, if I was working in a big bank and I was getting 100k, 80k as a designer, and I went to a startup, I'd want 80k. In fact, I'd want 90k because whenever you move jobs, you want to get extra money. And when they said, well, look, actually, we can pay you 70k and 0.5% in equity, they'll go, no, I want the full amount of money. And I'm happy to not do the equity, or I want the equity as well, which is problematic. What I'm really trying to encourage people to realise is when they go and take a job, don't just look at the headline figure of the salary. Look at the whole package. If you get free bikes or like a bike to work scheme, do you get, extra holiday time? Do you get health insurance? Like, look at the whole package. And the equity is a part of that. And what you often find is a lot of startups nowadays will give you an offer. They'll say, hey, look, where are you at the moment? Do you want to have more cash or more equity? And think hard about that decision. Like, think hard about, hey, look, what will I do with that extra 10k? Is a fancy car or a nice holiday now worth the potential for a new house in 3 or 4 years' time, or 10 years' time? And if it is, that's a very, very sensible decision, and no one's going to begrudge you of that. Maybe you've got a family, maybe you've got kids, but if you have the ability to kind of sacrifice some salary in return for an investment in a company you believe in, there's a chance of a real positive return. And to some extent, I think, like, if we really believe that design is transformatory, then shouldn't we be putting some of that at risk? Shouldn't we be saying, hold on, like, they're hiring me, I'm a bloody good designer. I'm employee number 6 or 7 or 8 or 10 or 20 or 50. Like, I'm a really good catch. And actually, like, I believe that I can make a difference to this business. And if I can make a difference to this business, I want more than just like the cash they're going to give me. I want to have a stake in the positive outcome. That's what being a business person is. Being a business person isn't just kind of taking a salary, and calling it a day. It's about, a smart deployment of capital and skills in order to get a much bigger return. So I think we need to start thinking like business people in our own financial decisions, if we ever want to also be seen as sort of realistic, sensible business partners for the businesses we work in.
Totally agree. I think that's a really important mindset shift that a lot of us in design need to explore a bit more. You're a venture partner at Seedcamp. They're a European VC firm that invests a lot in UK-based founders. Are you starting to see the tide turning as far as designer founders? You see more designers maybe reaching out to you for advice and coaching and investment and wanting you to connect them with VCs?
I think that the UK has typically lagged sort of 4 or 5 years behind the US, or at least the west coast of the US. In the last sort of 4 or 5 years, we've seen a lot more successful startups. We've seen companies like Monzo, we've seen companies like Deliveroo. And a lot of the early design leaders from those companies have gone on to do other things. For instance, Hugo from Monzo, who was the head of design there for many years, has gone on to start Packfleet, a kind of a new sort of city-based delivery kind of service. Nothing to do with design, apart from the fact it's going to be beautifully designed because Hugo's running it. We're seeing people like Stuart, who was head of design at Deliveroo, starting his new little stealth project. Like, I'm seeing lots of senior design leaders that have been in tech companies, have experienced what it's like, being encouraged to go off and do their own thing. And so, yes, I'm seeing that really exciting. I'm also seeing a lot more designers noodling around with their own product ideas. I think, the pandemic was a challenging time for many people, but a lot of people found that they had evenings and weekends back because they were not traveling, they were not commuting, and they had ideas they were noodling around with. I've seen quite a few people, sadly, who have been made redundant, but they've used that time, or they've used the money they got from being furloughed during the pandemic to kind of go and spend time building their own ideas out. So I'm seeing more and more designers reach out to me through Twitter, through email, through LinkedIn, saying, "Hey, Andy, I know you're interested in design. I've got an idea I'm 6 months in. Do you want to take a look? Let's chat." I don't think that would have happened 3, 4, 5, 6 years ago. I think the ecosystem is definitely more mature. And if that's where we are now, I think in 3 or 4 or 5 years' time, we're going to see a lot more of that happening. I think we're going to see a lot more designer founders, designer co-founders, founding designers. So yeah, I'm feeling very positive about that.
Nice. It's encouraging to hear that you're feeling positive about the future as far as designer founded businesses go. So yeah, Andy, thanks so much again for making the time today to share knowledge and experience in this space. If anyone wants to reach out to you, maybe they have a great business idea they're exploring and they'd like some advice about raising capital, or they're interested in your design leadership coaching, how can they find out a bit more about you and get in touch?
Well, as you'll know, I'm very present on Twitter, so I'm just Andy Budd on Twitter. So feel free to follow me and DM me if you want to chat, or LinkedIn, or my website's andybudd.com. But yeah, I'm always looking for passionate founders. Whether they're designers or they're just people building products that really care about design. So if you're kind of in that stage, if you're kind of got your idea to the point that you're looking to start to raise some money, you want maybe to someone to look over your funding deck, you maybe want a friendly VC that you can kind of connect to, please do drop me a line and I'd love to chat some more.
Fantastic. Thanks again, Andy. It was really, really great talking to you today.
Lovely to talk to you, Tom.